Hey guys, and welcome back to the channel. This week I'm going to be talking about investing with Vanguard, but not investing for myself this time, instead for my daughter, Isla. As you will see when we head over to the Vanguard platform, I do use the same tax wrapper as I use for myself, a stocks and shares ISA. But in this case, a junior stocks and shares ISA, or a JISA if you will. Not much of a ring to that. So as usual, I'm going to go through the portfolio, showing you where the money is invested, how it's performed, and showing you the real, unedited, unredacted numbers. But before we get going, please remember to subscribe to the channel. If you're already subscribed, thank you. It genuinely means a lot. And as a result of your support, I'm going to continue to create content and share it, all about this maze that is personal finance. Before I started investing myself, I didn't know much about an ISA. The extent of my knowledge was of a cash ISA that I had, but didn't really know why I had it. Then, naturally, I started to read and learn about a stocks and shares ISA, where you can invest money within a tax wrapper and not get taxed at all at any growth that you get as a result of it. This, to me, was very exciting. Then I learned about a junior stocks and shares ISA, where you can invest in stocks and bonds and shares on your child's behalf. Mind blown. So here is how the conversation went with my now fiance. Bearing in mind, she has always been sensible with money, and I've been the one that would spend every single penny I earned, and then a bit more. And in particular, going into debt with gambling, trying to find a quick solution to getting money. So I told her not only can we invest within the stock market within a tax efficient way, being an ISA, but we can also have access to that money at any point. But we can also do the same for our daughter. She laughed and said something along the lines of, "Your track record with money is not great, so I'm going to keep my money in the bank." Okay, so to put a bit of context to that, as soon as we found out that we were going to have a baby, back when I was working as a bartender, we both put money aside as much as we could for Isla's future. Neither of us had any money stashed away from us from our parents when we became adults, and we wanted to change that going forward. So we put money into a Lloyds Bank savings account with a fantastic interest rate of 1%. Now, over time that fluctuated, but it was safe to say that for 7 years we put money into this account. We may as well have just kept it under the mattress. Around this time, sadly, a relative passed away and they left Isla a few £1,000s, which went into the same account. So fast forward to me learning about personal finance and the magic of compound interest. I got to work convincing Georgie that investing for both of us was the right move. But not only just for us, I was thinking about Isla as well. So I put the numbers into a compound interest calculator, and I'll leave that link below in the description box. But I showed her that even if we got very average returns until Isla turned 18, she would have a comparatively sizable amount of money to buy her first car, a house deposit, or whatever at the time the money is needed for to jumpstart her financial life. So after many discussions, we came to the agreement that we would invest for her, but we were going to take a lower risk than we prepared to take with our own money in our own investments, meaning that we were going to put some bonds in the mix, not just solely investing in equity. So we took the leap and opened a junior stocks and shares ISA and transferred the money over in July 2020. Back then, markets were down as a result of the pandemic, and we just continuously added money to the account every month, whatever we could afford. So a few things you should know and consider when it comes to a junior stocks and shares ISA. ISA being an individual savings account. So firstly, it is for children under the age of 18 only. The ISA allowance is lower than an adult ISA, being capped at £9,000 a year as opposed to the current £20,000 a year for adults. Any parent or legal guardian can set an account up for a child. Friends and family can make contributions to the ISA as well as you. And at age 18, the account transfers to your child's name and you do not have legal control of that investment anymore. Now, all of these points for me are a huge positive. The only one I wanted to discuss a little bit further is the fact that at age 18, the account becomes your child's and it's not yours anymore, giving them the freedom and choice to do whatever they want with it. Good choice or bad choice. As daunting as this could be, especially when you consider the thought process you probably had when you were 18. But truthfully, I think this forces you to consider what you're teaching your children about money. and how to use it to live the life that you and they want. You're using it as a tool rather than something you just get down to zero in your bank balance every single month. Talking about personal finance and teaching them how and why they need to invest their money from a young age should set them up for success when they're older. Okay, so now we know a little bit more about a junior stocks and shares ISA. Let's head over to Vanguard to have a look at my daughter's portfolio. Okay, so here we are on the Vanguard app, and we can take a look at the junior ISA. So as you can see there, the total value as of today is £14,861.98. So total gain of £1,792.40 with a personal return of 16.43%. So it's a little bit better than what it was like inside the Lloyds saving account. Now, the only reason that we've put it into this account is because we know we have a time frame of more than 5 years for the money to grow over time, because I wouldn't want to risk the money in a downturn in the stock market in the short term if we needed that money to be accessed for a car or a house deposit. We're giving it time to grow. So it's important to remember that this growth that we've seen here isn't solely as a result of the stocks and shares ISA. You can see there that £1,700 is as a result of where we've invested this money within the stock market. But before that, it compounded by just putting in money to this account every single month. And there was a minimal growth of 1% from the interest that we got from the bank. But a lot of that money is the capital that we've put in simply from hard-earned cash. So realistically, it could be a heck of a lot more should we put this money in further. But we're not going to dwell on it, because the best time to invest was 50 years ago, but the next best time is today. So let's take a look at where that money is currently invested. So as you can see there, life strategy, 80% equity accumulation. So if you've watched any of my videos previously, you'll know that I invest myself in the Life Strategy 100. I've done a video before about the Life Strategy fund, which I'll link to above, but essentially the number after the life strategy within those funds correlates to how much equity is within that fund versus bonds. So the Life Strategy 80 is 80% equity and 20% bonds. So it's slightly lower on the risk scale than the Life Strategy 100 that I'm investing in. So that was our compromise. And then as you can see there, we have 57, nearly 58 units with an ongoing charge of 0.22%. The average unit cost that we've bought is £225.74, and the last unit that we purchased was £257.17. So the total cost of money that we've put into this account is £13,045.41. So the increase there of nearly £2,000 within the space of a year and a half of investing. So the return on investment there thus far is pretty good. So if we take a look at the performance of the investment so far, you can see there that we started in July 2020 with just under £9,000. And the reason for that is because the ISA allowance for a junior stocks and shares ISA, if you remember, is £9,000. So we didn't want to put any more money into the investment without the benefit of the tax-free allowance. So we put in 9,000. I think it was about £12,000 originally we had. So we held 3,000 back within an account for about 6 months until the new tax year started. So yes, we weren't getting that growth on it, but we wanted to be solely within a tax wrapper. So we waited, and as you can see the big jump up there, as soon as we could in April, and we put in the rest of the money. And we're still within our tax-free allowance for the year, so we're just going to continue to put in every single month, currently £50 every single month into the fund. So we're going to continue doing that, and that's going to be nowhere near the £9,000 limit. And then obviously, as we progress through time, and as hopefully the business does better, we will be putting more money into the fund. So if we move away from that and we take a look at actually where that money is invested within the Life Strategy 80, and as you can see there, just like the Life Strategy 100, it's quite heavily weighted towards the US, which I'm happy with. I'm not biased towards the UK. I don't think it needs to be just because I live here. I need to invest so much money into it. The truth is, there is quite a lot already in there. There's 24% of the fund goes to within the United Kingdom, likely to be major companies within the FTSE 100 and others. But it's very heavily weighted towards North America. But that is the market that sees a lot of the growth across the world. I'm happy to have a lot of the money within my stocks and shares ISA and also Isla's heavily weighted towards the US. So as you can see, there's US, then UK, but then there's emerging markets in there as well. You've got the Middle East, you've got Asia, you've got Japan, Europe, and South America. So it's got FTSE 100 in there, it's got the S&P 500, it's got all the big players that you would expect to see, but diversifies it to also get the benefit of any sort of emerging markets that seem to be doing well. And if there is a downturn in the US stock market, which there was very, very recently, it's still balanced out by the benefits of how the UK market's doing and also the rest of the world. So for me, there's a really good balance across the fund, and it's the perfect balance of bonds and equities, the risk level that we want to take for our daughter's money. So overall, I'm really happy with 16.43% growth. Now that is lower than it was. It was up to about 24, 25 a couple of weeks ago, but because of the downturn in the market, it is lower. But the beauty is, we were very lucky to start investing in quite a low point in the stock market just after the pandemic in 2020. So the growth that we're seeing was kickstarted by that. So this could be a different video if I invested when the markets were doing really, really well. And then over time, I might get 2-3%. So it's important to remember that, yes, I'm seeing good growth in all the investments that I'm investing in within Vanguard, my ISA and my daughter's ISA as well, and also Georgie's ISA. We're all seeing good numbers. But that is just a fluke result of when we timed the market. That's not intentional. You've got to remember that. It's not about timing the market, it's time in the market. And there you have it, my daughter's Vanguard portfolio within her junior stocks and shares ISA. Now remember, don't just copy anything you've just seen. That's just what I do, and I just want to show you what it looks like. If you want to invest for yourself or for your children, do your own research and make your own decisions. I hope that if you have children, or even if that's something in the future for you, that this video has given you something to consider about how to get the investment ball rolling for your kids and teach them along the way. Thanks again for watching. I really do appreciate it. If you get any value at all from videos like this, please hit the like button and subscribe to the channel so that you can check out any future videos that I'm going to release.